In this video, we're going to break down two under-the-radar stocks that could quietly double your money sooner than most investors expect. One of the companies dominates a niche category with deep customer loyalty and recurring demand. The other is a household name undergoing a strategic transformation that the market may be underestimating. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's start with the first company, Chewy, ticker symbol CHWY. Before we even talk about numbers, you need to understand why this business matters. Chewy is not just an online pet retailer, it is building one of the most powerful direct-to-consumer ecosystems in the pet care industry. And the key here is not just what they sell, but how they sell it. Pet ownership is one of the most stable long-term consumer trends you can find. People treat pets like family. That means consistent spending, emotional attachment, and extremely high customer loyalty. Once a household brings a pet into their life, that spending becomes recurring and often grows over time. Chewy has positioned itself right in the center of that behavior. Their core advantage is convenience combined with personalization. Through their auto-ship subscription model, customers can automate recurring purchases like food, medication, and supplies. That creates predictable revenue and high retention rates. Once a customer is in the ecosystem, they rarely leave. This is where the moat starts to build. The more customers rely on auto-ship, the more embedded Chewy becomes in their daily lives. Over time, switching costs increase. Not because it is hard to switch platforms, but because it is easier not to. That subtle difference is what creates long-term compounding businesses. Now layer on top of that their customer service strategy. Chewy has built a reputation for going above and beyond for customers. Whether it is handwritten notes, personalized recommendations, or even sending flowers when a pet passes away, they are creating emotional loyalty, not just transactional relationships. And emotional loyalty is one of the strongest forms of competitive advantage. Now let's talk about growth. Chewy has been expanding beyond basic pet products into higher-margin categories like pet healthcare, pharmacy services, and insurance. This is where things get really interesting. Pet healthcare is a massive and growing market. As pets live longer, owners are spending more on medical care, prescriptions, and preventative treatments. Chewy's pharmacy business is positioned to capture a meaningful share of that. And unlike traditional retail, healthcare carries higher margins and more recurring revenue potential. So now you have a business that already has a strong customer base. Layering in higher value services on top of it. That is a classic expansion strategy that drives both revenue growth and margin improvement over time. Financially, Chewy has been showing signs of improving efficiency. Revenue growth has stabilized after the pandemic surge, but profitability metrics are improving. The company has been focusing on cost discipline, logistics optimization, and leveraging its scale. This is a key transition point. Many growth companies go through a phase where investors focus heavily on revenue growth, but the real inflection happens when those companies start converting that scale into consistent profitability. Chewy is moving into that phase. Free cash flow has been improving, margins are stabilizing, and the business is demonstrating that it can operate efficiently even in a more normalized demand environment. And here is where the opportunity lies. The market often misprices companies during these transitions. When growth slows slightly, investors sometimes assume the story is over, but in reality, that is often when the business becomes stronger, more durable, and more profitable. Chewy is not trying to be a hyper-growth company anymore. It is evolving into a cash-generating platform with long-term expansion opportunities. That shift is not always immediately reflected in the stock price. Another important factor is customer lifetime value. Because Chewy operates in a recurring consumption category, each new customer has long-term value. Over time, the cost to acquire that customer becomes small relative to the total revenue they generate. That creates powerful unit economics. And when you combine strong unit economics with a large and growing market, you get a business that can compound value quietly over many years. Now let's talk about scale. Chewy has built a logistics and fulfillment network that allows for fast delivery, reliable service, and a wide product selection. That infrastructure is not easy to replicate. It takes years of investment and operational expertise. This gives Chewy an advantage over smaller competitors and creates a barrier to entry in terms of execution. So when you step back and look at the full picture, you have a company operating in a resilient industry with recurring revenue, expanding margins, strong customer loyalty, and a clear path to long-term growth. That combination is exactly what you want in a stock that has the potential to double over time. Not because of hype, but because of steady, compounding fundamentals. And importantly, this is happening quietly. There is no massive media buzz around Chewy right now. It is not dominating headlines. But under the surface, the business is improving, expanding, and strengthening its position. That is often where the best opportunities are found, because by the time everyone is talking about it, a large portion of the upside is already gone. Now, before we move on to the second stock, I want to share something with you. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the second company, which might be even more interesting from a turnaround and re-rating perspective. The second stock is Target, ticker symbol TGT, and this is where things get really compelling. Most investors think they already understand Target. They see it as a traditional retail company, a big box store with moderate growth and heavy competition. But that surface-level view misses what is actually happening beneath. Target is not just a retailer, it is a brand-driven, omni-channel platform with a powerful supply chain, strong private label portfolio, and deep integration between physical stores and digital operations. And right now, it is going through a reset that could set up significant upside. Let's start with why the business matters. Target operates at a massive scale across the United States, serving millions of customers every week. It sits at the intersection of essential goods and discretionary spending. That means it captures both everyday purchases and higher-margin lifestyle categories. That dual positioning is incredibly valuable. During strong economic periods, discretionary spending drives growth. During weaker periods, essential goods provide stability. Few retailers are positioned to benefit from both ends of that spectrum as effectively as Target. Now, here is where things get interesting. Over the past couple of years, Target has faced challenges. Inventory mismanagement, margin pressure, and shifting consumer behavior have weighed on performance, and the market has reacted accordingly. But this is exactly the kind of situation where long-term investors find opportunity, because what matters is not what happened in the past, but what the business is becoming. Target has been actively working to improve its inventory systems, optimize its supply chain, and restore margins. These are not quick fixes. They take time, but they are foundational improvements that can significantly impact profitability. At the same time, Target continues to invest in its owned brands. Private label brands are a major advantage in retail. They offer higher margins, stronger customer loyalty, and differentiation from competitors. Target has built a portfolio of in-house brands across categories like apparel, home goods, and essentials. These brands are not just cheaper alternatives. Many of them have strong design, quality, and customer recognition. This creates a unique value proposition. Customers come to Target not just for convenience, but for products they cannot find elsewhere at the same price and quality level. That is a competitive moat. Now layer on the omnichannel strategy. Target has one of the most efficient store-based fulfillment systems in retail. A large percentage of its online orders are fulfilled through its existing store network. That reduces shipping costs, speeds up delivery, and improves inventory efficiency. Services like curbside pickup and same-day delivery have become core parts of the customer experience. This is not just about convenience, it is about economics. By leveraging its physical footprint, Target can compete with online-first retailers while maintaining cost efficiency. That hybrid model is incredibly powerful when executed well. And as these systems improve, margins can expand. From a financial perspective, this is where the upside potential starts to emerge. Target's profitability has been under pressure, but the company has a clear path to recovery. As inventory levels normalize and cost structures improve, operating margins can rebound. And when margins recover in a business with this level of revenue, the impact on earnings can be significant. This is what creates the potential for the stock to double. Not explosive revenue growth, but operational improvement combined with a re-rating from the market. Because right now, expectations are relatively low. And when expectations are low, it does not take perfection to outperform. It just takes improvement, and Target is positioned to deliver that. When you look at Target today, you are not looking at a broken business. You are looking at a business that went through a difficult adjustment period and is now rebuilding its operating strength. And that distinction is everything. Because markets tend to overreact to short-term challenges and underestimate long-term recoveries. One of the biggest issues Target faced was inventory imbalance. The company overestimated demand in certain categories and had to aggressively discount products to clear excess stock. That compressed margins and created the impression that the business was losing its edge. But what matters now is that those issues are being corrected. Inventory levels are becoming more aligned with actual demand. Supply chain processes are being refined, and management has been focused on improving efficiency across the board. These are the kinds of operational fixes that do not always get attention in headlines, but they have a powerful impact on profitability. As those improvements take hold, margins begin to recover. And because Target operates at such a large scale, even small improvements in margin can translate into meaningful increases in earnings. This is where the quiet doubling potential comes from, not from flashy growth headlines, but from disciplined execution. Another key factor is consumer behavior. Even in uncertain economic environments, consumers still need to spend. They may become more selective, but they do not stop spending entirely. Target's product mix allows it to capture both essential purchases and affordable discretionary items. That positions the company well in a wide range of economic conditions. And as consumer confidence stabilizes, discretionary spending tends to rebound. That creates an additional tailwind for Target's higher margin categories. Now let's talk about something that often gets overlooked: brand trust. Target has spent years building a strong relationship with its customers. It is seen as a reliable, affordable, and slightly more premium alternative within mass retail. That positioning allows it to maintain pricing power while still attracting value-conscious shoppers. This balance is not easy to achieve. Too cheap, and you lose margin. Too premium, and you lose volume. Target sits right in the middle, and that is a very powerful place to be. Now combine that with its private label strategy. As we mentioned earlier, private label products are a major driver of margin expansion. Target's owned brands give it control over pricing, design, and supply chain. That means higher profitability and stronger differentiation. Over time, as these brands continue to grow, they can represent a larger portion of total sales, further improving margins. And again, this is not something that happens overnight. But when it does happen, it creates a compounding effect on earnings. Another important piece of the puzzle is digital integration. Target has successfully integrated its online and offline operations in a way that enhances both convenience and efficiency. Customers can browse online, pick up in-store, or receive same-day delivery. This flexibility increases engagement and drives higher overall spending. And because much of this fulfillment happens through existing stores, it avoids the high costs associated with building separate distribution networks. That is a strategic advantage. Now let's zoom out and look at the bigger picture. You have a company with massive scale, improving operations, strong brand equity, a growing private label portfolio, and an efficient omni-channel model. At the same time, the market is still pricing in a level of skepticism. That gap between perception and reality is where opportunity exists. If Target continues to execute on its operational improvements and margins begin to normalize, earnings can grow faster than revenue, and when earnings grow faster than expected, valuations tend to expand. That combination can drive significant upside in the stock. This is why turnaround stories can be so powerful, not because they are guaranteed, but because when they work, they often deliver outsized returns. Now, let's bring everything together. You have Chewy, which represents a high-quality recurring revenue business with expanding margins and long-term growth in pet healthcare and services. And you have Target, which represents a large-scale retail platform undergoing operational improvements with strong potential for margin recovery and earnings expansion. These are two very different businesses, but they share something important. They are both positioned for quiet compounding. They are not dependent on hype cycles or short-term momentum. Their potential comes from execution, efficiency, and long-term demand, and that is exactly the type of setup that can lead to a doubling over time. Not overnight, not in a straight line, but through consistent improvement and market recognition. Now here is something to think about. If you were building a long-term portfolio, you would want a mix of growth and stability. Chewy offers exposure to a growing niche with strong recurring revenue dynamics. Target offers exposure to a large, established platform with recovery potential and improving profitability. Together, they create a balanced combination of growth and value. And that balance is often what drives long-term success in investing. Because you are not relying on a single outcome, you are building a portfolio that can perform across different market conditions. Now before we wrap up, I want to share something for those of you who want to go deeper. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Between Chewy and Target, which business do you think has the stronger long-term advantage when it comes to customer loyalty, pricing power, and margin expansion potential? Let me know your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.